And continue the conversation with 314 Research co-founder Warren Pies. Warren, you say in this environment, despite the rally, you can't be underweight equities. Why?
Yeah, thanks for having me, John. We've been saying that since Q4 of last year. You just can't be underweight equities. Our base case is for a soft landing. Soft landing ingredients in our world has always meant a resilient economy, rapid disinflation, and more than anything, a Fed that really wants to go for a soft landing. Our calculation was that this is a political, an election year, so politics is kind of important, and the Fed was going to go for a soft landing. I think that was the message of last week's big Fed meeting. I still think, just like Mike alluded to, there are a lot of people who are underweight or are underexposed to this market, and they're going to scramble to get exposed. So I think the combination of a soft landing, a Fed that has your back, and underinvested strategists and just institutions in general means that this rally can keep going.
A few months ago, you had a bold call that energy was going to rally, that oil was going to rally. I should be more specific. And it did get to 90-ish, up toward 100. And then you're like, okay, got about as far as it can get in the near term. Any more bold calls?
Yeah, I'd say the bold call for me, we came into the year, we've traded oil pretty well. It's really our model, which our model has been great over the last few years. And it's been really locked in on the sentiment component of oil. And so we came into the year and there was a lot of pessimism, a lot of short positions from the hedge fund class. And so our model wanted to take the other side of that and go long. And we predicted that Brent crude oil would be in the upper 80s to, call it 90 by the end of Q1. But my call now is that we're in the, say, 8th inning of this rally. So, I think it's about as far as we're going to go. I've been saying 90 is a soft ceiling for oil and on Brent. So we're not that much more distance here. There's a lot of spare capacity from Saudi Arabia and from OPEC in general. So I think that sits on top of oil here. So my bold call from here is just, I would take profits if you were playing the oil beta in your portfolio.
Okay, I'm not sure that's what I meant. The bold call being no more bold calls, perhaps, at least on that one. But housing is important to you. So what's your conviction about what's maybe going to continue to do well, particularly well in this environment, or something that's going to do even really badly?
Large home builders have been an area that we like and we continue to like. I think this is a market that's tailor-made for national home builders. So you have the existing home market, which is locked up. You have everybody who has their 3% mortgages really can't move. So existing homes are frozen. We have rates which are high. And I think that in this soft landing environment, you don't see a bunch of downside for mortgage rates. So you have this kind of 7-ish% mortgage environment. And the large home builders can offer the incentives and buy downs to capture share. So we have a system, full cycle trend. This is a monthly stock selection system. We grab 20 stocks out of the S&P 500 every month. Since 2022, there's always been exposure to these national home builders, and we continue to have that exposure. I think everybody just says high rates are bad for builders, bad for home builders, and it's just a very shallow analysis for this cycle. So I still like, and we still like, our system still like home builders.
All right. Despite the rates not coming down, Warren Pies, thank you.
Thanks for having me.